Okay, well, it's great to see everybody. I'm dressed in my TradFi terrorist outfit, so you can identify where I'm coming from. I want to actually spend some time talking about what I think the future of tokenization is. And so just very quickly, I am known as a critic of things like Bitcoin, and the thought process behind what I would largely argue is a bunch of speculation. I do think that tokenization is the future, that digital securities are really important, and that actually is really critical because the simple answer is that TradFi is actually dead. It just doesn't know it yet. Mutual funds are now in decline despite asset appreciation. ETFs have taken their place for now, but as an ETF provider, Simplify, which has grown from about $200 million to about $7.5 billion in assets, I will tell you the asset class is lacking in true innovation. All we're doing is adding leverage. We are taking existing products and recasting them. So the point that I would make is that mutual funds are dead. ETFs are dead and don't know it yet. They're the classic grandma in the attic, dead, not yet buried. Tokenization is in its infancy, and it is the future. Digital tokens are really the key. The most important thing to understand about what's actually going on is that while TradFi appears incredibly robust, it's largely a mirage that is being driven by how we are investing. So the simple answer is passive investing, buying the S&P 500, participating in a 401k program where you're pushed into a target date fund is not passive. Passive means you never transact. Every single time you put money to work in your 401k plan, buying stocks, you are pushing them higher. We have removed the discretion about how to value assets. This is causing prices to rise, even as the companies themselves are increasingly forced into competition they didn't anticipate and forced into conditions that ultimately are causing them to invest unproductively. Right? This is not the focus of my presentation. I encourage you to look up my work. Simply Google my name and passive investing. You will find all sorts of stuff on it. It's worth understanding that we are dying even as we appear to be growing. When passive strategies become too large, all we're basically doing is we're giving systematic algorithms control of the process. When they get too large, they create their own endogenous volatility, the market thins out, and you create a crash. When I first discovered this, I saw it around the world for the markets that were most penetrated by passive. I realized there was something called the inverse VIX ETF complex. I placed significant trades against it, highlighted the opportunity. Nobody believed me, which of course you can understand, and predicted that the XIV ETF would go to zero on a 4% decline in the S&P. On February 5th, 2018, I'm not sure why it says 3018, that's a little bit aggressive, it went to zero on a 3.9% decline in the S&P 500. Right? Was never supposed to happen, but this is what happens when you outsource to algorithms that are not actually thinking about what they're supposed to do. Now, ironically, we have always had cryptographic tokens. A dollar bill is a cryptographic token. It carries a serial number, it carries significant anti-counterfeiting components. A stock certificate, Enron, for example, is also a cryptographic token. As has been pointed out, it gives you ownership in shares in an enterprise that ultimately was lying about what it was doing. Does that sound familiar to tokenization advocates? We are doing X when you're actually doing Y. The current process of securitization is basically you come up with a product idea, you then have to conform it to regulators, and then in the classic Richard Feynman sense, it's just lawyers all the way down. Right? Enforcement is focused on after the fact. I can actually raise a fund, I can say it does X, it can do Y, and if nobody complains, nobody finds out until the product either implodes or I'm celebrated afterwards for having done something that nobody thought I was actually doing and I made a whole bunch of money. Right? That's a terrible strategy. What we need to do is actually recognize that tokens are securities. But because of the way we're approaching regulation, because we're trying to go around regulation, our design constraints are that we have to stay below the Howey line. That means in order to avoid being labeled a security, we have to avoid profit-sharing mechanisms, managerial promises, governance rights, and enforceable obligations. In other words, everything that makes an investment interesting. These are not investments, these are collectibles. And just like collectibles in the .com era, what we're doing is we're trading them on glorified eBays. Right? That's really what is going on so far. If we're going to change this, we have to move from where we are right now, where we're talking about wrapping TradFi products and tokens. And to be very, very clear, my firm is in the process of doing this. We will be introducing our first tokenized ETF, in other words, wrapped TradFi. They'll be coming from Simplify this year with partners like Alpha Ledger and Plume. Our partners are working with the Solana Foundation. This will begin the process of offering US citizens diverse ways of investing in TradFi assets without going off-chain. But that's not the exciting part. The exciting part is the digitally native securities, right? Creating products in which we've embedded fiduciary capability for truly unique products. This can mean a mortgage that is originated on-chain, but it can also mean that you're taking traditional claims against companies, putting them on-chain. Akshay gave the example of a coffee shop that has a QR code that allows you to instantaneously buy a share of that. My observation of Akshay is what you've actually done is create an incentive for me to subsidize a coffee shop, spend $100,000, fit it out, hire a bunch of fake customers, so that everybody thinks it's an absolutely fantastic opportunity, and then have a QR code on the wall that allows you to buy shares at $1 billion valuation. Right? Nothing in there actually stops that unless I actually turn the token into a fiduciary asset that discloses in advance everything that you're actually buying. And we now actually have the technology stack that allows that to happen. We have AI that can function as our own individual fiduciary litigator that says, hey, guess what? This token that says it gives you ownership at a $1 billion valuation of a local coffee shop. Does that seem sensible? No, it makes no sense whatsoever. Therefore, you probably shouldn't buy this thing, right? We change regulations from an environment in which we're thinking about, am I conforming to the letter of the law in my filing application, to one in which the regulator is simply able to say, does this do what it says it does? In other words, truth in labeling, more like a functional FDA than a securities regulator. You should be able to promise almost anything you want, but if you're going to promise it, you should be required to deliver. And that is the whole point, right? We are a social species. Trustless does not exist. It's a marketing scam for collectibles. Trust me, bro. Right? The philosophy of trustless and censorship resistance and a governance that is informal and plutocratic and a use case in which we're just trying to do value storage or speculation, that's not actually allocating capital. Code is law is not correct. What is correct is that we should be engaging in a trust-enhancing and a stewardship-oriented token. We should be focusing on how do we actually prevent companies from doing what they shouldn't be doing with your money. That can be done in a digital token era. Effectively, each individual token becomes its own sentient bank account that says, are you using this in the manner in which you described it? And if you aren't, it should automatically send an alert to the investor that says, hey, that Mike Green is a kind of not trustworthy guy. And if Mike Green wants to do something that's not on there, I should be required to reach out to my investors and ask them to vote. Should we change the mandate? All of this can be accomplished today, right? What we want to move to is an environment in which the law itself is encoded. The law is code. We want to be in a position in which we are capable of doing enforcement, of preventing bad actions before they happen, simply by virtue of entering into a contractual relationship in which you are limited as the end user from being able to do whatever you want with the money once you have it. The money ceases becoming totally fungible. It actually becomes directed. When we do a corporate share issuing, we often talk about use of proceeds. Imagine if use of proceeds that said this money can only be used for AI investments. or this use of proceeds can only be used to build a factory in the United States. There's no reason we can't do that today, right? But we have to embrace it and approach regulators from the standpoint of we can do this better in cryptographic and in digital tokens than we can in TradFi, in which I fill out all the right forms, and I use all the right language, and I conform to the 40 Act, or I conform to the Jobs Act in terms of the issuance of securities, but then I go off and do something totally different with the money. That's absurd. We're past that point. Trust is life, right? Okay, trust is not life, but trust is an integral part of being a social species. If I want to invest in your product, I have to trust you. We should be using tokens to enhance trust, not simply saying, you should have done your work on that, man. Okay, so what is a fiduciary token? A fiduciary tokens are programmable digital assets designed to embed the fiduciary obligations and legal accountability directly into the token architecture, rather than relying on external institutions, i.e. SEC, or discretionary enforcement from the Department of Justice. Right? Those are overburdened institutions. If we want to introduce innovative products, we need to make their job easier, not harder. Don't spend our time trying to run away from them. Embrace what they're actually trying to accomplish and show how we can do it better. The objective here is to reintroduce trust, stewardship, and legal logic into a financial system that's currently dominated by regulatory standards focused on what you can say and then ignore what you actually do, until, of course, problems occur. Post-event enforcement is overloaded by a regulatory system and a court system that candidly won't see any clarity for years. Why has it taken so long to work through the FTX bankruptcy? Right? Shouldn't be happening that way. Right? Regulatory arbitrage. We actually just had Kraken up here on stage talking about tokenizing equities. Where will they be tokenizing and offering them? Offshore. Because really what the rest of the world needs is a greater opportunity to invest in US stocks that currently make up 55 to 60% of global market cap. That's absurd. Right? It's a novel and it's an innovative approach, but it's designed to skirt regulation rather than work with regulators to enhance the system. And then the last part is technocratic abstractions, right? What is a security? Well, this is not a security. This is a security. This is not a security. This is, that's absurd. The objective of investments is to position yourself for an ownership share and a stream of profits and cash flows from those. Pretending anything else is just not make any sense whatsoever. So as we talk about a feature set that's matched to purpose, and I want to be very clear, I am not a developer. I am not a programmer. I cannot do this. I'm asking you to help me, right? And if you're willing to help, I'm happy to work with you and I'm happy to promote your work. But the simple reality is we need to embed the governance logic. The token enforces rules. If I tell you I'm launching an ETF in tokenized form that invests in large cap technology stocks, and I suddenly try to start buying government bonds, it should tell you, hey, this guy's drifting. He's doing something that is not right. And I should then have to approach you and say, I'd like to change the strategy because I don't think the opportunity set is there, and you can vote to get your money back, or you can vote to actually allow me to do it. It's up to you. But that's the entire point of agency and ownership, is you should have a vote other than simply the exit vote. AI-readable legal standards. All the documents should be translated into AI, and it should immediately identify that it conforms to everything. We can use zero-knowledge proofs, by the way, to do all sorts of stuff without exposing things in a HIPAA-compliant type manner, which is how you should approach your financial future. All I care about is, do you have enough money to pay the bill when I check your credit? I don't actually care what you did with all your money, right? The same underlying component should be associated with a company that claims it's a blockchain specialist but is actually a Subway shop in New Jersey. Right? Regulatory mirrors, tokens mirroring existing legal frameworks to make them legible and enforceable by code. Again, I shouldn't be able to do things that are illegal with it. Built-in recourse mechanisms, automatic triggers for dispute resolution. He tried to do something, that triggers a vote. I can get my money back, or I can continue to allow him to hold it, not doing what he wanted to do, sticking with the original plan, or I choose to vote and allow him to do it. Programmable use of funds. This is a really astonishing one. Again, if you think about this concept of the use of proceeds, imagine municipal debt that is issued that says this is going to be used for school construction. Right? In a tokenized framework, it can only be used for school construction. You can identify the vendors that are actually in that process. You can audit it on a real-time basis. Right? All of a sudden, the slush funds are gone. You're actually enforcing the behaviors. And so with only 7 minutes of time, that's where I'm going to wrap up. I encourage you all to think about embracing the regulation, approach regulators from the standpoint of they were trying to do the right thing. They are simply overwhelmed. So stop asking them to chase you like Keystone cops and instead show them you can do it even better. Thank you very much.